Hi everyone, this is Mike Kramer of Mott Capital. Today is January 30th. It's around 7:15 New York time. So today was a big day. We got the JOLTS report, the highly volatile JOLTS report, hard to predict, came in stronger than expected. 9.0 million was about 250,000 better than expected. Last month revised higher to 8.9 million from 8.8 million. The fund will continue tomorrow. We're going to get at 8:15 in the morning ADP employment. We're looking for 150,000 jobs to have been created versus last month's reading of 164. The big number that the Fed watches very closely is this employment cost index. That will come at 8:30. This quarter's estimate is for 1% versus last quarter's actual number of 1.1%. And also at 8:30 in the morning, you're getting the Treasury quarterly refunding announcement, which really could have a big effect on Treasury rates and on the dollar index, because this is when the Treasury will come out and tell the market basically, does it foresee issuing more bills? Does it foresee issuing more coupons? And this is really the big question, is where are they going to issue more debt? Are they going to continue to issue it towards, are they going to try to issue more debt towards the back of the curve, or are they going to continue to flood the market with bills? And this is an important metric to look at, and it may actually be even more important than some of this economic data, or could even be more important than the big show of the day at 2 o'clock, the big FOMC rate decision. There's no expectation for a no rate change at this month's meeting. What is interesting, obviously, is following the stronger than expected JOLTS data, we can see that expectations for rate cuts continue to get pushed back. Right now, market's only looking for about a 43 to 44% chance of a rate cut by March. This is a big change from where we were back at the end of December, when the market was pricing in more than one rate cut by the time we got to March. So there's a big shift. Economic data certainly has not been supportive of a rate cut in March. We're going to get more data tomorrow, and we're gonna see what the Fed has to say. Generally, from listening to different Fed governors and board members over the last several weeks going into the blackout period, it seems like this idea of a rate cut in March was something that was probably baked in too aggressively by the market, and it's more likely than not that the Fed is going to probably try to delay any signals for rate cuts. And there's also some minor expectation that we're going to learn a little bit about, maybe the Fed slowing the pace of quantitative tightening as well. And so with that, we should probably turn our attention to yields first. The 2-year yield right now looks fairly interesting because, again, we have this momentum which is suggesting that maybe the 2-year yield is trying to put in some sort of bottom here and turn higher. And then when you couple it with what looks like maybe an inverse head and shoulders pattern here, suggests that there could be, again, a little bit of a sign of 2-year rates moving higher. The news tomorrow, I think, is largely going to shape whether or not you're going to see the 2-year move up. The 2-year really needs to get above 442, 443 to really see any upward shift to around 460 or so. What could potentially have that happen? Obviously, if the Treasury again signals that it's going to issue fewer bills this time around than it did in the fourth quarter, if it signals fewer bills, more coupons, it potentially shifts 2-year rate higher. Clearly, the Fed pushing back on rate cuts also potentially pushes 2-year rates higher. And it looks like from this type of pattern, it looks like the 2-year is in a position that it could move higher from here. The 10-year yield's also been trying to getting to move higher, but again, the 10-year yield has been struggling. Even though we had stronger data today, we didn't see the 10-year yield really break out. It's been struggling to get past this 415 level now for some time. Momentum still looks fairly bullish in the RSI. Obviously, if we were to break below 42.5, that would probably indicate that rates move lower. You can see right now that at least as of today, we moved below the 10-day exponential moving average now. And so we're going to want to watch to see if we can get back up. Usually if you go below it for 1 or 2 days, not really a big deal. It's what happens on the 3rd and 4th day that really matters and can tell you a lot about where things are going to go. You can also see that right now we're also hugging the 20-day moving average as well, and in the middle of the Bollinger Band. So really for the 10-year, it needs to hold on to this 4% level. If we drop below 4%, it could mean there's more trouble to the downside back to 382. But again, if we try to continue to get this data that's supportive of stronger economics, and then you get the Fed pushing back on things, you get a quarterly refunding announcement that's shifted more towards the longer end of the curve, and you can get the 10-year back above the 415 level, it could have some room to run to 435 or so. Again, it's not really entirely clear. And here you can see the same thing with the 30-year, a very similar setup. You have momentum clearly still on the upside, although there are signs of it breaking down sort of right around this 50 level. You're going to want to see 50 hold and potentially bounce. You're going to want the 20-day moving average to hold. You're going to want to get above the 10-day moving average pretty quickly for us to avoid seeing lower rates. Clearly a break of this 419 level, which has been support in the past and resistance. You break this level and you're talking about a retest to around 395 or so. So there certainly is varying difference in terms of how the 2-year rate looks versus what you're seeing on the 10-year rate and the 30-year rate. And this could be indicative of what the market is kind of positioning for going into the QRA, going into the Fed meeting tomorrow. And so you're going to want to pay very close attention to all of these things. The dollar index also sort of just having a really tough time at this point getting above this 103 area. Again, momentum still fairly bullish looking. We haven't really shown signs of completely breaking down yet, but we're going to want to watch because if we trace back to 50 on the RSI and break 50, momentum is clearly shifting. Also, you can see that the 10-day exponential moving average continues to serve as a support level, and it looks like we're consolidating in here in this what looks like a symmetrical triangle or so. If we sort of just look at this pattern, it would suggest maybe we see a breakout to the upside. We saw something similar taking place in here, and my theory is as long as we hold the 10-day exponential moving average, I think that the momentum is still to the upside. If we do get a Fed that pushes back against the market on rate cuts, if we do get stronger economic data tomorrow, then the bias would be for the dollar to rally. And while we can think about all these things in advance, price action matters the most. And until we clear this 103.5 region, the dollar isn't going anywhere because the dollar needs to get through resistance for this to really have any sort of meaningful push. And for that to happen, you got to get through 103.5. You got to that opens the door to 104.5. But again, until we get that breakout, the dollar looks like it's just kind of stuck in the mud. And you're seeing it a similar look right now in the euro. The euro has been trading well below the 10-day exponential moving average. We can see that there's a bias right now with momentum still pointing lower. So this is something that we'll need to keep an eye on. Clearly here's a trend line in the euro. You could maybe make a case that there's some sort of falling wedge pattern forming here. Maybe it suggests that we see a euro retrace back up to this 108, 109 region, potentially pushing to 109.5. If we kind of just stick with the momentum and stick with the information we have, until this exponential moving average is broken to the upside, we have to assume that it continues to serve as resistance and that downward pressure still exists. If we look at the pound, I don't know that we're going to see all that much has changed. In fact, the pound just keeps oscillating back and forth. It looks like something is about to give, though, one way or the other, because it looks like momentum has basically stalled out at this lower level, and you can see we're running out of room here and creating this downward-looking triangle. So either the pound is going to see momentum materially break lower at this point, or it's going to break materially higher. And if we were to kind of try to look for some clues here, it's not really all that easy to find some. But when we at least look at maybe what's happening here, you can see that there's this downtrend in place. And at the same time, you have this uptrend that's in place. And you can see that also you're consolidating here as well, which also tells you that the days of the pound moving sideways are probably coming to an end. Again, if we just sort of look at the shape of this formation, it looks like we could see a pound that eventually breaks lower towards 125. But again, we're looking at a situation right now where it's going to be largely determined by the messaging that comes out of these the Treasury and also the Fed, and it's going to be dependent on what rates do. But generally speaking, again, the momentum still tells us that the pressure and the direction of momentum is still lower until something changes. And we look at the USD versus the yen. So far, we've been unable to surpass this 148.20 level. You can see we're still trading right around the 10-day exponential. That's still serving as support. We can see that there's some lost momentum here in the yen. We didn't really quite get above these previous highs either, which suggests that maybe momentum's not as strong as we thought it could be. And right now you're looking at a spot where, you really have to hold 147 in the yen in order to keep an upward bias. If 147 breaks, it looks like we could go back to 145 3/4, and to get above 148.20 likely leads to a rise to around 145.70, maybe even back towards the highs of 150, 150 or so. But again, I think in order for some of these things to happen, for the dollar to break higher against the pound, against the euro, against the yen, and really strengthen, and the DXY to move up, it's going to probably take a more hawkish than not Fed, and a lot's going to be dependent upon how the Fed positions itself going forward after tomorrow's meeting. So anyway, I hope you have a great rest of your day, and I'll talk to you again soon. Bye.